measuring business transactions. So our goals for Chapter 2 is we're going to learn about the concepts relating to trying to decipher recognition, valuation, and classification, and try to understand when a business transaction should be recognized, how it should be valued, and how it should be classified. We're also going to look at why those are important ethical issues and some situations where businesses maybe violated rules relating to recognition or valuation or classification, and so therefore acted in an unethical fashion. We're going to look at the double entry accounting system, which you guys are already familiar with. We did double entry accounting system the whole first chapter or the whole first semester of the year. We're also going to look at various different transactions, which would how we would apply the concepts of recognition, valuation, and classification using double entry. We're going to prepare a trial balance, which again we should already be familiar with because we've done trial balances before. And then we're going to look at what are some limitations of trial balances that you guys again should be familiar with from first semester. And then, let's see, we're going to look at charts of accounts, which will be a little bit different this semester compared to last semester because we're dealing with more types of accounts. We're dealing with our longer-term assets, our long-term liabilities, and we're dealing with Stockholders Equity section as opposed to sole proprietorship. And then, lastly, we're going to show how the timing of different transactions affects cash flow for a business and their liquidity. All right. So let's get started with the measurement issues. So our objective here is to explain the concepts of recognition, valuation, and classification and how it applies to business transactions. So the role of measurement is to take our economic events that we have in a business and then figure out when those economic events should be recognized, how they should be valued, and how they should be classified. So let's look at each one of those different things individually. And these economic events all have effect on the financial position of our company. So, first, recognition. Recognition refers to when the actual transaction occurs. It's basically a predetermined point in time that we're going to record the transaction. So, for instance, we can say that a sale is measured or recognized when title passes from the seller to the buyer. We also want to look at recognition because we have different things that can be taking place in a business, but they may not yet be an actual transaction. So, for instance, I gave you guys the example in the past of, let's say I want to go out and purchase something within here, as in the school. Let's say I need to replace my desk. If I want to go about replacing this desk, it's not. I don't just like go over to Office Max and just go in and purchase a desk. What I've got to do is I've got to figure out, well, what supplier or vendor am I going to use? I'm going to evaluate different desk options. None of those things yet result in an economic event. Then, if I want to order the desk, I finally pick it out, I pick out a vendor. If I want to order the desk, I have to put in what we call a purchase order, a purchase requisition. And I send basically the information regarding the desk, information and the vendor, and I basically kind of put in a purchase order through our accounting department, and it says, okay, I want to order this desk, I want to order from this vendor, and it's going to be this much money. Then the accounting department down in district office will then send an order request over to the vendor. Let's just say I'm going to use Office Max. They're going to send, pardon me, a request over to Office Max to purchase this desk. Again, no economic event has taken place yet. Then, once Office Max actually ships that desk and it's sent to me, that's when we actually have an economic event. Okay? That's when the title is going to pass from them to us. Okay, then I have an economic event, and I have to recognize that economic event. I'm going to recognize that economic event as basically an acquisition of an asset. Depending upon how I'm going to pay for it, maybe I'm going to pay for it in 30 days. So I'm going to debit my desk asset, and I'm going to credit my accounts payable to OfficeMax. Okay, from OfficeMax's standpoint, at the point when they ship it to me, okay, they're going to recognize a sale and they're going to recognize an account receivable. So for both of us at that point in time, that's when the recognition piece is going to take place. Okay. When they receive my order, they're not yet recognizing that sale either. Okay, because again, they've just received the order. They haven't done anything to recognize that yet. Okay, so that's the thing that's become a little bit tricky, is finding out when is the recognition point for your company and your transaction. Now this is really pretty simple. Desk is pretty finite and simple. More complex is trying to figure out what's the recognition point as I'm, say, building a bridge. Okay, $10 million, or I don't know, $100 million to build a bridge. Okay, when do I recognize different things associated with the building of that bridge? When do I recognize the asset? When do I recognize the liability? All those types of things. It becomes a little bit more complicated. Okay? Second thing, valuation. What's the monetary value that we're using? In our transactions, we're always using dollar value. But even within that, it's further complicated by trying to determine what dollar value should we use. Okay? So GAAP, Generally Accepted Accounting Principles, says that business transactions should be valued at the fair value exchange price between the participants. So again, we have to try to figure out when does that occur. In GAAP, generally speaking, we use cost as our verifiable valuation point. Typically speaking, we use cost as opposed to fair market value or market value. The cost principle basically says that the acquisition cost is something that can be distinguished. It can be recorded. It's verifiable. So the cost principle is typically what we use as the valuation of different items. Now, there are also situations where we do use fair value to record transactions. And fair value is used when there's a market that is readily discernible as it relates to a certain item. So a lot of you may have seen on your financial statements for the companies that you're evaluating where they might have some investments in securities, meaning that instead of taking all their millions of dollars in cash and keeping them in a bank account, they take some of that cash and they invest it in securities, and they manage those investments. They have usually a treasury department that manages those types of investments on a daily basis. What securities should they have? What securities should they sell? Et cetera, et cetera. In those types of situations, we would value those usually at market value, because the market value at any given point in time is discernible. You can literally go and determine what the market value is of a publicly traded stock at any given point in time. Okay, so in those cases, we'll use fair value or market value for the valuation method. But something like a building like this, if we say this building, what's the fair value of this building? Is it hard to determine? Very difficult to determine. Okay, it was built at a certain point, or various portions of it were built at different points. We can determine cost, but if we were to determine the price to sell it, how would you determine that price? There's nothing comparable to it anywhere near here. Okay, and even if we were to try to compare it to other schools around, is it going to be the same as comparing it to a school all the way over in Niskayuna or Bethlehem or Albany or Schenectady? It's not the same. So it's very hard to determine a fair value for something like this. Much easier to determine and quantify what the cost was. Okay? So that's the valuation issue. From an international perspective, the international financial reporting standards, there's a challenge that we have because the international standards, financial reporting standards, are a little bit different than generally accepted accounting principles. In the United States, we use generally accepted accounting principles. Internationally, many businesses use international financial reporting standards. They're trying to see if they can get them to be the same or close to the same, but there's still differences. And so they're both working towards trying to establish a commonality in terms of valuation, the valuation issue. And they're not quite there yet, but they're working towards coming up with a commonality, because in other countries where they use international financial reporting standards, they use fair value as the valuation method. Okay, so that makes it a little bit more difficult. So one of your things when you guys, some of you wanted to look at companies that were international companies, it makes it that much more difficult because it's not like comparing apples to apples. Okay, if you're looking at a company that is reporting based on international financial reporting standards, their assets and stuff are going to be listed differently than a company that's using generally accepted accounting standards. Okay, so you're not comparing apples to apples. Third item, classification. And this is that same question we've asked since the beginning of the year. Which are the accounts that are affected by each transaction? Okay, and so like let's say we purchase tools. If we purchase tools, should those tools be included in repairs expense, or should those tools be listed as an asset on our balance sheet? Okay, and those, it makes it a little bit difficult. And a lot of times what businesses will do is, let's say you have a tool that's a small tool, like a screwdriver or a hammer, very, very inexpensive. So they might, even though that's going to be technically an asset to that business over a long period of time, the cost of that item is so low that it's not a significant enough expense for the business to try to depreciate over a long period of time. So they expense it because the value of it is so insignificant compared to the total value of the business. So you have to look at things like that. So you might expense something that might technically be considered an asset just because from an accounting standpoint it doesn't make sense to continue to hold it and value it over time. Another issue or example is if you have a company, say like CVS, and they buy paper towels and they're going to sell those paper towels to customers. Would those assets be considered inventory, or would those assets be considered assets that they're going to use in their business? So for instance, if they were going to be using them in their business, then those would be considered some sort of supply or asset on their books that they're going to put, in a long-term asset category. Whereas if they're going to be reselling them to customers, those paper towels are something they're going to categorize in their inventory. Okay, so two different categories of assets. If we look at this, how does that present challenges to businesses? Well, we can go back to some previous accounting frauds that took place, and we can look at some examples. So, Computer Associates, what they did when they got caught doing fraudulent financial reporting is that they violated the recognition rule by keeping books open after the true fiscal period end. So they made their sales look better because they kept reporting stuff in one financial period when it really took place in another financial period. Okay, so they violated the recognition rule. Another business, Enron, they violated guidelines for valuation. What they did is they violated it by transferring assets between their companies. Stops recording. So they added them on instead of consolidating them. And then lastly, we have WorldCom. And they reported certain assets as expenditures that should have been classified, certain assets that they should have classified as assets, they recorded as expenses. And WorldCom at the time was considered to be the largest financial fraud in history. It took place in 2007, 2008, and it took place over several years, and basically they overstated their net income. They overstated their net income by $10 billion. What's a couple billion between friends? Okay? Yeah. So basically what they did, you know how I just gave you that asset example with the hammer? And I said if you have a hammer, maybe it's such a small cost to a business, you would just expense it. Well, what they did is they turned around and they reported things that should have been expensed, and they reported them as assets. Okay? So it made their expenses look very low, and so therefore made them look much more profitable. Okay? So you can see how being unethical in using those measurement tools, not applying them correctly, can really result in significant financial problems. All of these companies ended up going bankrupt. Okay, so here's a little stop and apply. And we can go through this afterwards. Let's go into the notes. We'll keep going through the notes. We'll get through section 2 of the notes. Okay, section 2 of the notes is relating to the double entry accounting system. For this, I would like for you guys to open up your textbook. So if you guys could open up your textbook, we're going to talk about double entry accounting, and we're going to refer to some problems in our books. So in Objective 2, we're looking at the double entry accounting system as a tool to help us analyze our transactions, just like we did in the first semester. So as we know, the accounting system is based upon a principle of duality, meaning for every economic event, there are at least two accounts that are going to be affected. Those two are going to offset each other. And if we go back to our rules from the first semester, we remember that we have with every transaction at least one debit and one credit that are of equal value. So our debits and our credits have to equal each other. So we have a debit and a credit, and they have to equal each other. We also know that we're going to have various different accounts that are affected. And our accounts are basic units of storage for accounting data. This is where we accumulate information relating to similar types of situations. The tool that we use to help us analyze our transactions is our T account. And we all know the left side of our T account is the debit side, and the right side is our credit side. There are three parts to every T account. The title, the left side being the debit side, and the right side being the credit side. This picture, this image is illustrated for you guys starting on page 94 in your textbook. And it gives an example of a T account and the various debits and credits and the totals of the debits and the credits. And then we can see that the balance is the difference between the debits and the credits. The working totals for each side are called the footings, and then the balance is the difference between the two sets of footings. Good? Okay. Every transaction increases at least, or affects, I should say, affects at least 2 accounts. There's always going to be a debit, and there's always going to be a credit. When we debit asset accounts, they increase the asset accounts. If we credit asset accounts, it decreases them. When we credit liability and stockholders' equity accounts, that's an increase for them. And then when we debit liability and stockholders' equity accounts, that is a decrease for them. And again, this is illustrated on page 95 in your textbook. So if we again continue to reflect back to first semester, we remember the rules of double entry accounting, and total debits have to equal total credits, and dividends and expenses are treated like withdrawals and expenses were treated in the first semester, where they reduce the equity. Thus, therefore, increases to dividends or expenses are a decrease to stockholders' equity. And this is the same type of gigantic T account that I had done for you the first semester. So if you look at this T account, we can see, okay, here's that sort of the accounting equation blown out with assets equals liabilities plus common stock plus retained earnings. Retained earnings are affected by dividends and revenues and expenses. So revenues minus expenses are either a net profit or a net loss. And then this again refers to all that normal balance stuff. Remember, the side that an account increases on is its normal balance side. It decreases on the opposite of the normal balance side. Again, this is all familiar to you, correct? Am I saying anything that you guys need more emphasis on, or just keep going? Keep it going. Keep it going. Okay. Then we have our stockholders' equity. This is a really important chart for you guys to keep in mind. I would dare say it might even be a good chart for you to put on your vocabulary sheet for chapter 2. Because this is basically the accounting equation. Assets equals liabilities plus stockholders' equity. Stockholders' equity equals common stock and retained earnings. And then it kind of blows out the, investments, dividends accounts, revenue accounts, and expenses account. And it emphasizes how revenue minus expenses are shown on the income statement. Dividends and all of these are actually shown on the statement of retained earnings. And then our stockholders' equity, common stock, is shown outside of this box. It's separate, handled separately. So, okay, it's in your textbook. It is in your textbook on page 96, this picture, okay? 96. So the accounting cycle is a series of 6 steps. We kind of shorten it up a little bit from our 8 steps that we talked about in the first half of the year. But it's basically analyzing our transactions using our source documents, recording our transactions in the journal, posting, doing the adjustments, posting and preparing a trial balance, doing the adjustments and an adjusted trial balance, preparing financial statements, and then closing the accounts after you do post-closing trial balance. So an overview of the accounting cycle is basically what we see here. Here's our measurement, recording, posting, adjusting, closing, and then preparing and issuing our financial statements. And this is basically taking our business activities and putting it through the accounting cycle so that we can communicate our financial information to our decision makers. Then our decision makers make decisions about what our future business activities should be based on this. Okay, so we're going to stop there. What I would strongly encourage you to do is just be aware of these graphs or charts that are included in the notes that are also in the textbook. Okay? All right, let's stop right here.